Historic low mortgage interest rates are redefining the housing market, and we will see the impact of today's mortgages last long into the future. If you haven't been paying attention to real estate market and mortgage market conditions, then I want to encourage you to take a few minutes to consider some options they present and how your decisions today are going to affect you financially in the future. In today's video, I'll show you examples of how homeowners have been impacted by changing mortgage interest rates, give you a glimpse of the future real estate market, and show you 2 inside tips on how to prepare for these changes today. Hi, I'm Joe Manassa, author of The Business of Getting Business and the creator of Manassa.com, where I've helped tens of thousands of people buy and sell homes. I would like to help you too. If you already are a subscriber, thank you and welcome back. If you're not a subscriber, please consider becoming one now. We offer the most thorough and accurate housing market reports on YouTube, plus answers to your real estate frequently asked questions, and we also provide virtual tours of some of the most beautiful homes in Tallahassee. Simply hit subscribe to get started, and the bell so that you're the most informed buyer or seller in your next real estate transaction. Let's start this off with a look at current mortgage interest rates. This graph shows a monthly plot of mortgage interest rates going back more than 50 years. The mortgage data in the graph comes from Freddie Mac. Freddie Mac is the nickname of the government-owned corporation that buys mortgages and packages them into mortgage-backed securities. Its official title is the Federal Home Loan Mortgage Corporation. Banks use the funds received from Freddie Mac to make new loans to homeowners. The graph shows the average monthly mortgage interest rate since the beginning of 1971. This graph really does a great job of demonstrating the significance of today's low mortgage interest rates. They are not merely slightly lower than the historical norms, they are overwhelmingly the lowest interest rates on record. In order to put this into perspective, I have produced some numbers to show how the typical homeowner or home buyer will be impacted by today's low rates. I was motivated to prepare this video after receiving a few questions on my latest luxury homes report, which you can see by clicking the link below the video. In case you missed the report, 2020 posted the most luxury home sales ever recorded, so I wanted to further explore the impact of low mortgage interest rates on this fragile segment of the housing market. When the cost of money declines, home affordability initially rises. Buoyed by low mortgage interest rates, buyers can qualify for and afford more home based upon monthly mortgage payments they have to handle. In order to demonstrate this, I want to compare 2 separate buyers. The first buyer will be referred to as the Y2K buyer, as this person will be buying a home at the prevailing mortgage interest rates back in the year 2000. The second buyer is today's buyer, who will be purchasing at an incredibly low market rate of 2.25%, which we've seen a few times lately with buyers we've helped in their acquisition of a new home. This table compares borrowing $800,000 at 2 different rates. The table on the left is today's super low rate of 2.25%, while the table on the right is the 8% rate that buyers were happy to get back in 2000. Today's buyer will save a whopping $1 million in interest payments over the life of the loan when compared to the Y2K buyer, whose payment is 92% higher in order to include the extra interest required to repay the loan. Can you see why there are more luxury home buyers today? When you drop $1 million off the mortgage interest requirement, it opens the door to a lot more people. The next table explores this even further. While the first table revealed the principal and interest differences for 2 buyers, this table looks at affordability by including real estate taxes and homeowners insurance, which will be included in the monthly mortgage payment. Furthermore, there's an entry to show what today's buyers would be able to afford at the Y2K rate, keeping the principal and interest the same as with today's rate. The circle in the table shows the total monthly payment required by each buyer, while the information to the right of the circle estimates the income requirements for each in order to qualify for the loan. The Y2K buyer would have needed a household income a full $100,000 a year higher to buy a luxury home than does today's buyer, and this is one reason that luxury home sales are so strong right now. The bottom line in the table shows that today's buyer, if limited to the 8% mortgage interest rate that we saw in Y2K, would only qualify to borrow $417,000. That's just over half of the luxury home amount. Here's what I believe the future holds for the housing market and mortgage interest rates, as well as my top 2 tips for everybody. renters, homeowners, and homesteaders alike. If there is one thing we can be certain of, it's that mortgage interest rates will rise again someday. Probably not too soon, as the economy has major strides remaining to recover from the economic impact of the COVID-19 pandemic. But rates will rise. Hopefully, we'll see rates move higher at a very slow pace, allowing the market to adapt over time. But if we see a quick jump in rates, we'll see home affordability plummet and buyers and demand will drop like a rock. This will impact all segments of the real estate market, but more so at the very top of the market. So many of today's luxury home buyers are empowered by low mortgage interest rates, so the first segment to see a quick reduction in buyers will be at the very top of the market. One comment I see from time to time relates to the fact that many loans today are assumable for qualifying buyers. This means that future buyers will have the ability to, with a fee, assume the seller's loan on the home. While this might sound like a market-saving process, the fact is, without some changes to current loan conditions, this will not help many buyers or sellers in the future market. You might be thinking, hey, when future mortgage interest rates are up at 6 or 8%, won't buyers just love these homes that have assumable loans at a 2.5% rate? Well, yeah, they will, but no, they won't be able to assume them. Here's why. Several years into the future, these homes will have a lot of equity. The loan being assumed will not cover the entirety of the purchase, so tomorrow's buyers who want to assume a loan will have to come up with the cash to offset the difference between the purchase price and the closing costs versus the remaining loan balance. So let's look at an example of how this might play out. In the left column, we see a purchase today using the same interest rates and values as used in our previous tables. Assuming property values appreciate at an annual rate of 3.5%, the homeowner will have paid down the loan enough that the buyer will need to come up to closing with an additional $679,000 plus closing costs. That equates to a down payment of 53%, which is far beyond what the typical buyer can scrape together. With today's assumable loans, it's not likely we'll see assumptions 10 years down the road, unless the loans are modified to allow secondary financing. This would give today's loans great shelf life because, in our example, the buyer can bring a normal 10 to 20% down payment, borrow money as a second mortgage at the future market rate, and then assume the first mortgage at today's low rate. The resulting blended rate for the future borrower would be well below prevailing rates at that time. Will this be possible? I wouldn't bet on it because it's not likely going to be in the best interest of the note holder to keep a low interest rate loan on the books. But if the housing market is in a bad way, I would not be surprised to see some action by the government that might make it beneficial so that the housing market can transition back to normal. The big variable in everything I've laid out will be the pace at which mortgage interest rates move higher. If they move too rapidly, sticker shock will all but shut down demand from buyers. People will be mortgage locked in their homes as the cost of new money will make moving a financial hardship. The market will rely heavily on people who have to move, thus we'll see values likely decline to offset the home affordability gap. If mortgage interest rates rise slowly, the housing market will be able to move forward as normal, albeit at a slower rate of sales than what we're accustomed to seeing. So what should you do now? The question of mortgage interest rates rising starts with when, not if. You just have to know that these historic low rates are not the new normal. Perhaps we see them continue for another 3 months, a year, 3 years, who knows? But the economy will recover. The Fed will raise the funds rate and mortgage interest rates will rise. Without even factoring in our growing population, which means more new homes will be built, skyrocketing construction costs, skyrocketing wage increases, and rising development costs, we know the future cost to produce new homes is going to rise at a rate faster than what we have observed over the past 30 years. In other words, when the cost of building homes is a driving factor, homes will be more expensive. So, my first tip to everybody is to make a significant effort today to examine your current housing condition. If you are happy with your home and believe you will be happy with it for the long haul, you should evaluate your mortgage refinancing options. Speak with a trusted lender to see what kind of loan you can get on your home, whether you owe money now or own it free and clear. If somebody is going to lend you money for less than 3% on your home, you might want to pull out your equity to pay off all other debt and perhaps even invest the rest of it. I'm not simply saying that you should run out and borrow the money. I'm saying you should look into it so that you make the best decision possible for you and your family. On the other hand, if you know your home will not solve your needs or wants in the next few years, you really should look into buying your future home today. Costs are lower, both in terms of home values as well as the mortgage interest rate. I have included a link below to a report that forecasts home values and mortgage interest rates for the next 20 years, and you might be shocked at what the future holds. Moving to a more expensive home today might push you into uncomfortable territory with a larger mortgage, but there's a near certainty that several years from now you won't be able to financially handle the move. The next home will cost significantly more, and the money you borrow to purchase it will be at a much higher interest rate. Again, I'm not saying you should just rush out and move at all costs. I'm recommending you take a serious look at doing so. The fact that today's mortgage interest rates are incredibly low means that there's an opportunity for those who take action. Don't let the future you be upset with the present you because you failed to take action when you had the chance. If you would like to see videos with answers to questions from viewers just like you, I've assembled a great playlist that you can view by clicking on the box in the top left corner of your screen. For a playlist of recent housing market reports, just click on the box below it. Please remember to like this video, check out the links below it, and subscribe to our channel so that you never miss anything.